Hi, welcome to the Bond Market Podcast from INR Bonds. I'm Arjun Patsati, and we are 2025 with a lot of questions to ask. Too many things happening coming into 2025 across markets, whether it's bonds, whether it's equities, it's credits, etc. And there is no one single factor that can say we can positively will drive markets up or sideways in this year. So we definitely we are coming in with a lot of uncertainty in the whole market space. Looking back, uh, we have seen in 2024 the best performing asset class was gold, which gave 29% return. And on a risk adjusted basis, that is, the 10-year GSEC gave a 10% plus kind of a return in 2024. Given that this is a risk free asset, this is much better returns as compared to the large cap equity index, which just gave about 12%. And the rupee fell about 3% in 2024. So looking back in 2024, clearly gold being the best asset class in terms of performance was one gold as a safety asset against a lot of other domestic and global factors. One was inflation, the risk aversion on the global front, and especially on worries over currency markets. So coming into 2025, given the trend in 2024, what could potentially be the outcomes of this on the economic front, the policy front, and the outcomes of the market, and what should investors be doing in 2025? Yeah, let's start now. Before I start, let me welcome Sambit Roy, a young analyst, credit analyst from Capital Gate Investment Advisor, which is a SEBI registered advisory firm, uh, which is focused on providing the best-in-class credit research to the bond market participants. Welcome, Sambit, and let's get on with the podcast. The what are we going into 2025? Let me put it in three ways. One is in the economic front. Clearly, there is a downturn that is visible. The second quarter GDP numbers were pretty below forecast. Then you on the then uh, on the uh, performance side of the economy, there is clearly a visible downturn in many of the sectors, including vehicles, including consumption, etc. And there is also been a credit down cycle. So those of you who had listened to our podcast in December on the credit down cycle would understand that India is going through a credit down cycle. And while we go into the podcast, Sambit here the issues on the credits raised by the RBI's financial stability report. So clearly, economy is on a downward path, and the rupee itself, the way it's been falling to record lows against the US dollar, has shaken up the markets to a bit because we had a long period of stability in the rupee, and where portfolio flows were very positive. We had accreted to foreign exchange reserves, which touched record highs of $705 billion. And suddenly all this has turned upside down, where rupee has started to fall fast, and RBI has been selling dollars and bringing down the foreign exchange reserve to closer to by about 50 bill, by dollars to $650 billion. And while this is clearly trend, because one we all know that uh, RBI foreign exchange to prevent depreciation of currency can never uh, hold on for a long time. Long time, it will add to the volatility in the economy. And the third is obviously on the global front, where there are many issues. China is facing a slowdown, they're getting stimulus. Global central banks have started to cut rates but held back recently. Fed has cut rates but guided for cautious 2025. Then the US debt issues have come to the forefront for the Fed. Inflation forecasts are still very, very uncertain across global central banks now. And in India too, we have had inflation come down and then again go up. And RBI, while confident on keeping inflation close to its target range of 4%, has sounded out that it's still a risk. And in the December policy, they have mentioned that while they will continue to watch inflation. So with all these together, we go into two main events for India in 2025 in February, which is the Union government's budget and the RBI policy. Now, given that there is a clear downturn in the economy, will the government will the government look to fiscally boost the economy by both direct spending as well as through tax cuts and other things, but basically increase the fiscal deficit or increase the borrowing, whichever is this way. And the aid the government by cutting rates starting as early as February. Remains to be seen, but these are two main events. But clearly, there is concern on the credit cycle and on the credit front itself. Sampath, can you just take credit concerns raised by RBI in its financial stability report?
Yes, so RBI has highlighted the worsening asset quality in unsecured loans segment in its recent financial stability report for December 2024. RBI said that the credit growth for NBFCs slowed to 16% from 22% a year earlier, mainly attributing to a high base effect and regulatory changes. Unsecured lending fell from 27% growth rate year on year to 15% year on year, mainly due to the retail and bank lending segment declining to NBFCs from 13% to 6.4% year on year. In September 2024, we saw a shift in bank deposits towards high interest term deposits, reflecting heightened competition for savings. Also, the credit GDP narrowed to negative 0.7% in quarter four, signaling a more sustainable credit expansion. These trends highlight a cautious lending environment amid evolving regulatory and market dynamics.
Thank
In
you,
the micro,
Sampath.
yeah,
Sorry, carry on. Sorry, you're okay.
Uh, in the microfinance segment, the credit was driven by mainly NBFC, MFIs, and other NBFCs. It also slowed down after the recent stress that RBI mentioned. The ICRA and other crediting agencies revised their growth downwards to about 10%, which is still a healthy growth, but downwards from about 20% year on year.
Right. Thank you, Sampath. So it clearly shows that at least in 2025, lending is not going to be robust. If we had believed that markets were all performances were very strong in the corporate front and the economy was doing well, was on two factors. One was consumption spend, fueled by personal loan, unsecured loans to both on the personal loan front as well as on microfinance sector. Now, with stress in these sectors and the rapid growth, clearly 2025 is definitely going to see some kind of sharp slowdown in this kind of lending. And with this kind of lending slowing down, clearly consumption should come down as well, and this should lead to a slowdown in the consumption sector and other sectors which are related to this kind of a unsecured borrowing. Apart from that, then if there is a consumption slowdown across, then you definitely have that are going to be careful on the capex. Look to preserve cash flows rather than increasing the. They're not going to see any great demand in the next or more. And on the global front, also with the rupee falling, depreciating like this, there could be a lot of risk aversion on capital flows into the country. Various policies by the US government and other governments as well, then the global markets could also be evolving fast in terms of showing more volatility and showing more uncertainty. So in all this, you have the government that is going to present a budget in 2025. And in this budget, the expectations would be that if corporates are not going to consume and corporates are not going to spend on capex, then it's up to the government to pump prime the economy. So there could be a fiscal expansion, but if there is a fiscal expansion, then there is a increase in inflation going down the line. But normally in a slowdown cycle, what we have seen is that along with the fiscal expansion, the central banks also start to reduce rates. So expectations are that the RBI could actually signal a rate cut in February. At least if they don't cut it in February, they should signal their first policy for the next fiscal year. Very largely, this is due to the fact that uh, the central bank would want to show that it's starting to turn accommodative. And given that there's a slowdown in consumption and other application could be on a lower path or could be steady. But again, to a very all this points to um, uh, uh, what I would call as uh, clear uncertainty because it rests on many other things as well. That is, there's the global inflation is not imported into India. There's no geopolitical risk, and in the domestic front, the fiscal policies, expansionary fiscal policies, do not result in high inflation and low growth. So if this happens, then the economy gets into more trouble, and RBI will be very cautious. So here, what will the markets be? Bond markets um, will start to factor in a lot of these uncertainties. So the GSEC, the government bonds are is that the fiscal expansion and rate cuts would lead to lower can and containment of inflation. And if there is enough demand for government bonds, both on the domestic and global front, if the rupee stabilizes at higher levels, then there could be more flows into the government bond market and yields could trend down. On the other hand, if market believes that with fiscal expansion, then possibilities of rate cuts can diminish, sharp rate cuts can diminish, and inflation may not come down, and there could be global inflation coming into India, then the government bond yields could either stay range bound or could even move up. On the credit side, on the corporate bond side, clearly the credit down cycle and the liquidity that is like dying out slowly in the economy could affect credit spreads. On the other hand, because of higher credit spreads, the risk premium on higher yielding bonds goes down as the markets tend to factor in a true level of risk on those bonds. And that could offer investors a good opportunity to lock into good kind of spreads on strong, fundamentally stronger companies, getting a very decent risk return profile on their credit portfolios. On the equities and gold front, clearly on the equities front, the markets would be looking at whether the valuations are matching up to earnings. And if there is continued visibility of fall in earnings, the markets could move, could factor in that. And if there is a visibility of fall in earnings and then rise in earnings later down the line, then there could be some kind of investments coming into equities um, uh, as the markets have fallen. On the other hand, the gold, given its rally in 2024, would largely watch out for what's happening to the US dollar and how the US new government policies would affect the dollar, and whether it could add fresh turmoil to global currency markets. If there is more turmoil in those markets, gold could continue its rally. But having said that, can it rally from such high levels? Again, remains to be seen. So nothing, as I said, it's very difficult to come into a conclusion of where the markets are. So the best way investors should look at is to get a good balance of portfolio with reasonable weights towards asset class, which is enough to, and expect returns to enough to beat inflation and not expect too high returns in any asset class that they want to invest in, and just stabilize the kind of portfolios till fresh directions can be had. So thank you very much for listening in. But just to highlight the risk in bond markets, bonds carry interest rate risk, credit risk, and which is default risk and liquidity risk. And investors should be aware of these risks before investing in bonds.